Ladies and gentlemen, good day and welcome to Axis Bank conference call to discuss the Q1 FY23 financial results. Participation in this conference call is by invitation only. Axis Bank reserves the right to block access to any person to whom an invitation has not been sent. Unauthorized dissemination of the contents or the proceedings of the call is strictly prohibited, and prior explicit permission and written approval of Axis Bank is imperative. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions at the end of the briefing session. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. On behalf of Axis Bank, I once again welcome all the participants to the conference call. On the call, we have Mr. Amitabh Chaudhry, MD and CEO, and Mr. Puneet Sharma, CFO. And now hand the conference over to Mr. Amitabh Chaudhry, MD and CEO. Thank you, and over to you, sir.
Thank you so much. Good evening and welcome everyone. Apart from me and Puneet, we also have on the call Rajiv, Deputy MD, Amit Talgeri, Chief Risk Officer, members of the bank's leadership team, Subrat Mohanty, Ravi Narayanan, Sumit Bali, and Munish Sharda. We continue to move forward with clarity and intent in a quarter where the external signals were mixed. The system credit growth picked up with double-digit credit growth for the last 4 months. Consumption has continued up, working capital demand is strong, and together with refinance requirements are driving credit growth. However, the higher than expected inflation rate and the global headwinds will mean further rate hikes and tightening of liquidity. There could be some moderation in the short term. However, we do believe that the medium-term opportunity for Axis Bank is significant. We continue to grow faster and gain market share in our identified segments that provide better risk-adjusted returns. We remain focused on 3 core areas of execution to move forward on our GPS strategy. First is deepening a performance-driven culture. We have lifted the growth trajectory and consistently gained market share across various business segments and now have strong market position in multiple businesses. On deposits, we have gained over 100 basis points market share in the last 5 years to reach 4.7% as of June 2022. On advances, our incremental market share has been closer to 9 to 10% over the last 5 years, and closing market share stood at 5.7% as of June 22. In credit cards, we continue to be ranked 4th largest with over 17% incremental market share in the last 6 months and 12% market share on period end basis. In merchant acquiring business, we are now the 2nd largest, up from rank 4 in March 2021. Our Burgundy AUM has grown 3 times in the last 5 years, and we are the 4th largest player in wealth management business now. On the payment side, we continue to have strong positioning with 16% market share in UPI and 15% in mobile banking. As discussed above, it is evident that our digital footprint is 3 to 4 times our market share in our traditional businesses. Similarly, on the wholesale side, we are now transaction bank of choice with market share gains in transaction-oriented flow businesses. We have doubled our foreign LC market share from 5% to over 10% in the last 3 years. Our GST and RTGS market share continues to be strong at 9% in Q1 financial year 23. We have been the leading player in the DCM space over the last decade. On deposits, if you refer to slides 17 to 21, our customer acquisition remains strong. In Q1, we added 2.2 million new customer accounts, a growth of 22% year-on-year. The strong growth in our granular deposits continues with average CASA balances up 16% year-on-year. Our liability strategy driven through premiumization, granularization, and deepening remains on track, reflected in average savings account balance growth of 16% year-on-year and 4% quarter-on-quarter. We continue to see improvement in the quality of our deposit franchise. We are leveraging our wide suite of product portfolio to offer customized solutions for specific markets. We have started seeing traction in our corporate salary acquisitions led by a One Axis approach and productivity lift across the channels. 100% plus year-on-year growth in new salary labels acquired in Q1. Our Ultima salary program has seen significant adoption in our customer base. On current account, we remain focused on driving value and relationship-led core current account growth. Our strong positioning in the transaction flow businesses and our wide suite of transaction banking APIs have helped to drive acquisition and balances growth. On a QAB basis, we grew current account balances by 15% year-on-year. In term deposits, our growth has been higher than the industry, and our cost of deposit remains extremely competitive. Our term deposits grew at 13% year-on-year on Qrq basis. The growth in our non-retail term deposits was led by non-callable high-value deposits that are LCR accretive. Digital remains an important acquisition engine across deposit products. We source 26% of non-salary SA accounts and 55% of individual CA accounts through digital means. Further, 68% of individual retail term deposits by volume and 46% by value were acquired through fully digital channels. Our credit cards acquisition in the quarter were up 4 times year-on-year at about 1 million cards. We are today the fastest growing card acquisition franchise. In quarter one, we witnessed strong momentum across our focus retail and SME business segments that grew 25% year-on-year and 27% year-on-year respectively. Overall loan book grew 14% year-on-year. We have built a well-diversified and high-quality SME book in the past 2 years. We have replicated the learnings from SME segment to similar businesses like small banking business on the retail side and mid-corporate book on the corporate side. Mid-corporate book grew 54% year-on-year and 5% quarter-on-quarter. The SBB segment delivered strong growth of 74% year-on-year, led by our innovative product offerings like digital business loans, merchant cash advance, small ticket Suvidha loans, new account aggregator product variants, along with our end-to-end digital fulfillment capabilities. The combined portfolio of these 3 segments, small business banking, SME, and mid-corporate, grew 41% year-on-year and now constitutes 19% of the loan book, up 500 basis points in the last 2 years. Formalization of MSME lending and high contribution of MSME segment in India's GDP offer tremendous opportunity. We continue to invest in the SME space, extending our distribution and service footprint across India. Within corporate segment, we brought down the low-yielding offshore trade book during the quarter and chose not to pursue low-yielding deals in line with our focus on driving profitable growth. Our government business performance remains strong as we continue to add new mandates and gain market share. The government business has transitioned from being deposit-centric to being more solution-centric. We deliver and deploy holistic customer-specific solutions for payments, collections, and liquidity management across single and central nodal agencies. Over the last 18 months, we have deepened our relationships across various government businesses and signed MOUs with Indian Army, Indian Navy, Police, and Forest Department, among others. Within the private sector banking landscape, we have been a pioneer in government business offering competitive products and solutions to the institutional and retail customer. On the second point on our deepening of performance-driven culture, we continue to focus on improving profitability metrics. While Puneet will provide granular details, let me highlight the key metrics. Net interest margins improved 11 basis points quarter-on-quarter and 14 basis points year-on-year to 3.6% in quarter 1 financial year 23. NII grew 21% year-on-year and 6% quarter-on-quarter. Fee income was up 34% year-on-year, with retail fee up 43% year-on-year. Our core operating profit grew by 17% year-on-year. PAT was up 91% year-on-year. The combined quarter 1 financial year 23 analyzed PAT of our domestic subsidiaries stood at rupees 1,082 crores, up 10% year-on-year. The bank's standalone ROE at 15.07% was up 596 basis points year-on-year. Third was around fostering a winning mindset. Our winning mindset is reflected in our strong business performance and multiple external recognitions we received during the quarter.
NIMs, growth in NII, core operating profit, benign credit costs, and significant improvement in our ROA and ROE. NII for Q1 FY23 stood at 9,384 crores, growing 21% YOY, 6% Q1Q. NIMs for Q1 FY23 stood at 3.60%, growing 14 basis points YOY and 11 basis points Q1Q. We had clearly articulated the drivers of our NIM improvement journey over the next 8 to 10 quarters. The progress against the key drivers in the quarter are as follows. The improvement in balance sheet mix to loans and investments from other assets. Loans and investments now comprise 87% of total assets at June 22 as compared to 84% at March 22. Within advances, INR denominated loans comprised 93% of total advances at June 22 compared to 91% at March 22 and 89% as at June 21. Within advances, the retail and CBD segment comprise 69% of advances as at June 22 compared to 67% at March 22 and 63% at June 21. Low-yielding RIDF bonds declined by 5,816 crores on a YOY basis and 402 crores sequentially. The bank continues to improve the risk profile of its loan book. Our NII as a percentage of average risk-weighted interest-earning assets stands at 7.26%, improving 30 basis points YOY and 15 basis points sequentially. Our fees stood at 3,576 crores, growing 34% YOY. 93% of our fee is granular. Total retail fee grew 43% YOY. Digital and mobile banking fee grew 121% YOY and 3% sequentially. Fees from retail cards and payments grew 62% YOY and 13% sequentially. Fees from third-party distribution grew 27% YOY. Transaction banking, forex and trade-related fees grew 22% YOY. Trading loss for the quarter stood at 667 crores compared to a profit of rupees 231 crores in the previous quarter and a profit of 556 crores in the same quarter last year. The MTM is largely in our corporate bond book, 79% of which is AA plus and above rated, and 98% is rated A minus and above. We do not expect an economic loss on this book. MTM on the book had an adverse impact on the standalone ROA and ROE for the quarter of 16 basis points and 172 basis points respectively. Operating expenses for the quarter stood at 6,496 crores, growing 32% YOY and declining sequentially by 1%. The YOY increase in rupee crore expenses can be attributed to 40% for volume-linked increases, 14% for growth investments, 11% for digital and technology, 6% towards collection expenses, 5% for statutory costs, 5% for one-time expenses, and the balance 20% for BAU. Expenses sequentially declined by 80 crores or 1%. This is attributable to the reduction in 103 crores of one-time expenses reported in the previous quarter, 372 crores due to lower collection expenses, lower volume and operating efficiency in the quarter, offset by 395 crores of incremental expenses on growth, technology, statutory costs, manpower expenses, and annual increments and ESOP costs. Technology and digital spends grew 42% YOY and constitute 9% of our total operating expenses. Staff costs increased by 18% YOY and 16% sequentially. We've added 6,150 people from the same period last year, mainly in our growth businesses and technology teams. We have continued to maintain the Social Security Code provisions. The cumulative Social Security Code provision in the books of the bank now stand at 227 crores. Operating expenses to average assets stood at 2.24% for Q1 FY23, higher by 19 basis points YOY and 7 basis points sequentially. Given the strong momentum across our businesses, we remain committed to consciously invest in our focus business segments. The lower credit cost over the past few quarters has provided us some headroom to run operating expenses at slightly elevated levels. This has not affected our ROE delivery trajectory. We have demonstrated our ability to improve the cost ratios, having brought them down to below 2% in the past and continue to demonstrate the same through a sequential decline in expenses. we remain committed to achieving around 2% cost to assets in the medium term. Operating profits for the quarter was 5,887 crores, declining 5% YOY, largely due to the MTM loss. Core operating profit for Q1 FY23 is 6,554 crores, growing 17% YOY and 5% sequentially. Provisions and contingencies for the quarter were 359 crores, declining 89% YOY, 64% sequentially. The bank has not utilized any of its COVID-19 provisions in the current quarter. This is entirely prudent and in no way a reflection on the credit risk on the books of the bank. Annualized credit cost for Q1 FY23 is 0.41%, declining 129 basis points YOY. Profit after tax grew sequentially to 4,125 crores, growing 91% on a YOY basis. Consolidated ROE for the first quarter stood at 1.48%, improving 60% or 55 basis points on a YOY basis. Subsidiaries now contribute 4 basis points to the consolidated ROE. Consolidated ROE for Q1 FY23 stood at 15.66%, improving 587 basis points YOY. Subsidiaries contribute 59 basis points to the consolidated ROE. The cumulative non-NPA provisions stand at 11,830 crores, comprising COVID 5,012 crores, restructuring provisions 1,259 crores, unsecured retail within the restructured book is 100% provided for, standard asset provision at higher than regulatory rates of 4,141 crores, weak assets and other asset provision of 1,418 crores. Our provision cover, all provisions NPA plus non-NPA by GNPA stands at 133.51%, improving 1,587 basis points YOY and 182 basis points Q1Q. Our standard asset provisions stand at 1.70%. The bank is well capitalized and carries adequate liquidity buffers. Our total capital adequacy ratio, including profit for the quarter ended 30th June 2022, is 17.83%. Our CET1 ratio is 15.16%. Prudent COVID provisions translate to a capital cushion of 58 basis points over and above the reported capital adequacy. Our average LCR ratio for the quarter is 116%, exit LCR at 123%. Our excess SLR is 75,636 crores. The risk-weighted assets for the bank as of 30th June stands at 65%. Growth across our liabilities and loan franchise. Amitabh has discussed the progress in customer acquisitions, growth in liability and loan franchise in his opening remarks. Please refer slides 17 to 21 for details around the quality of the liability franchise growth and slides on our loan franchise and quality. In line with our articulated strategy, our loan book continues to get more granular and balanced, with retail advances constituting 59% of overall advances, corporate loans at 31%, and our commercial banking loans at 10%. 69% of our loans are floating rate, which positions us well in a rising interest rate environment. Breakup of the floating rate loan book by benchmark type, MCLR repricing frequency is set out on slide 10 of the investor presentation. Moving to our retail business, Q1 FY23 retail disbursements were up 77% YOY. Small business banking, rural and PL disbursements were up improving 751 basis points YOY and 253 basis points QNQ. We have not sold any non-performing loans in the quarter. The bank has a time-driven, rule-based write-off policy for retail and CBG portfolios. The net slippages in the quarter, adjusted for recoveries from written-off pool, was negative 17 crores. Net slippages for retail, CBG and wholesale were 475, 14 and negative 506 crores respectively. Recoveries from written-off accounts for the quarter were 744 crores, improving YOY and QOQ by 456 crores and 25 crores respectively. Reported net NPA slippage for the quarter was 727 crores, declining 82% YOY. Net slippage ratio for the quarter on an annualized basis is 0.41%, improving 219 basis points YOY. On a segmental basis, reported net slippages in retail were 869 crores, CBG 38 crores, and WBCG was a negative 180 crores. Gross slippages for the quarter were 3,684 crores, lower by 43% YOY and 7% sequentially. Gross loan slippage ratio for the quarter stood at 2.05%, improving 210 basis points YOY and 33 basis points sequentially. For the quarter, 45% of the gross slippages are attributed to linked accounts of borrowers which were standard when classified or have been upgraded in the same quarter. Standard COVID restructured loans stand at 3,402 crores or 0.45% of our GCA, with a provision cover of 24%. We collected 5% from the opening standard restructuring book during Q1 FY23. BB and below pool of the bank declined 38% YOY and 13% sequentially. Upgrades and recoveries during the quarter aggregated 652 crores, constituting 7% of the opening book. New downgrades in the quarter were 113 crores, down 91% YOY. More details on the BB below and restructuring have been provided on slide 54 of our investor presentation. To summarize, our balance sheet resilience is visible through strong capital adequacy, net NPA at 0.64%, overall coverage at 133.51% of GNPA, and limited COVID restructuring of 0.45. Early improvements in the quality of the granular liability franchise is visible through reduction in outflow rates. As we have indicated previously, this will take 8 to 10 quarters to fully play out with some inter-quarter fluctuations. The average CASA balance stood at 43%. Focus growth segments like retail, SME, mid-corporate with better ROC continue to grow faster at 25%, 27% and 54% respectively. The reported consolidated Q1 FY23 annualized ROE at 15.66% is in striking range of our commentary of visible ROE of 16% to 16.5% over the medium term. We continue to closely monitor the geopolitical outlook, inflation and liquidity risks, and resultant government policy action and its impact on our businesses. We would be glad to take your questions now.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Maruk Adjania from Edelweiss Financial Service. Please go ahead.
Yeah, hello. Congratulations. My first question is on loan growth outlook. So, of course, you've done very well on your focus segments. However, if you look at overall loan growth, then, what would be the outlook for the next 9 to 10 months? Will we be able to do double-digit YOY growth? Is that a fair assumption? Because that is key to constructing an earnings model, right? Obviously, your margins are improving, and that should help, but...
So, hi, thanks a lot for the question. We have delivered double-digit growth. We have always stated that we will continue to grow faster than the market. We have given a range of how much will grow faster than the market, and we continue to maintain that particular guidance. In this particular quarter, in the last couple of quarters, we've been saying repeatedly that the pricing in sub-segments of the wholesale side don't make so much of sense for us. We do expect, with all the rate hikes that have happened and that might happen in the future, that and with the what we are seeing in terms of behavior by other banks, that the hopefully more discipline will return on pricing, both for the working capital side and the term loan side, and hopefully that should feed into our loan growth going forward. Just to show a growth in our advances and have a consequent impact on our NIMs did not make a sense to us. We have a very clearly outlined strategy on delivering a certain ROE. As part of that, we have said that we need to deliver a certain NIM, certain cost ratio, certain credit cost, and that's what we are focused on. We do believe that as we continue on this journey, the loan growth will come when the prices return to normalcy. And because we have an extensive corporate franchise, we are one of the key banks to the corporate India. And frankly, when you want to look for that data, please see our growth on the fee income side. You see our foreign LC market share, our GST market share, the traction we're getting in Project Neo. So we are not too worried about getting that loan growth back at the right time. We're just waiting for the right pricing to resume, which we believe should happen in the next couple of quarters, if not earlier. I hope that answers the question for you.
Yes, thanks a lot. My next question is on deposits. So basically, last quarter you had talked about reclassification of some deposits from retail to wholesale. All that is done, or is something pending there?
A small amount is still pending, but most of that work is almost done. But a small amount of deposits is still pending, and that's why you would see that you are seeing a growth in the deposits coming from the NRTD rather than RTD side. If you look at the number of NRTDs which have been opened and compare year to year, there is clear growth which is visible from our perspective. And again, as we said, we are quite confident that the granularity in the franchise is there for people to see. We continue to work on our Triumph project, and we expect to continue to see this granularity coming through in the future quarters also.
Sure. My last question is just on Opex. So obviously, the Opex improvement has been good this quarter. You did explain the delta as well. But that's all. I mean, any near-term target, I know longer term is 2%, but your Opex tends to be very volatile. Like in the fourth quarter, we had guided to some uptick in Opex. So what is the stable ratio in the near term that we could look at? And any comments why employee expenses have risen so sharply QOQ? That has happened even for ICICI. So asking.
Maruk, thank you for the question. I think let me break my response into three parts. To the point that we had said last quarter, expenses will go up. Our cost to assets was 2.17 when we closed quarter 4, which was our reported number. Our cost to assets has gone up in line with our commentary to 2.24%, which is principally led by the investments that we continue to make in our growth business. So the cost
of NIM from
Abhishek, I'm
here?
really sorry. Abhishek, I'm sorry, I can't hear you too clearly. Would you please repeat that, what you're saying? I'm sorry, not audible
Sure.
at all, please.
Am I audible now? Hello?
Yes, Abhishek, better now.
Okay, thanks. My question was on NIM. A couple of quarters back, you had given a sort of medium-term outlook of 20-30 bits improvement in NIMs driven by several factors. And, we've in the last 2-3 quarters. So what is the outlook from here? And also, if, you start growing again in corporate and, maybe international loans, does that would be a drag as well. So how do you counter that?
So Abhishek, what I had commented 2 quarters ago is when we were at NIMs of 3.4%, we had said that we have a NIM improvement journey of 30 to 40 basis points that we want to cover,
Right.
so that we get to a NIM range of 3.7, 3.8. That helps us deliver the aspirational ROE. That commentary and that trend or execution against that commentary continues. We are 2 quarters from when we made that statement. From the 3.4 levels, we are up to the 3.6 levels. We haven't built the NIM accretion by drawing down on our LCR. So our LCR remains consistent over the quarters. This is business-led NIM improvement. We stay committed to getting to the 3.7, 3.8 over the next 8 to 10 quarters, which is a residual period of the comment we made earlier. And the direction to deliver that, in addition to the 4 variables I spoke of, was improving the quality and the composition of our liabilities franchise, which is work in progress. As we stand today, we stick to what we said, 3.7, 3.8 over the next 8 to 10 quarters. In terms of improvement is what we should be able to get to.
Sure. The other one is on Opex again. So basically, in the medium term, you do expect it to come down from current levels. But given your growing retail and maybe CBG more, what would drive the Opex down? Because these would incrementally be a higher Opex to asset business compared to, let's say, large corporate.
So a couple of things, Abhishek. One is we've said that we are making investments. The productivity gains from that investment need to play through the P&L, because investments are not made for the sake of making investments. So that's one. Second is, while we grow the granular business, we're also building on how the sourcing composition of that business can be, which is also a meaningful cost driver. So if you change the sourcing mix, you do get cost optimization even as you build granularly. So the cost journey will be a function of productivity gains from investments made plus tactical actions on our businesses. We do think it is achievable, and therefore we are sticking to what we have said previously, medium term around 2%.
Sure. And that is also, let's say, medium term would be 8 to 10 quarters, just like NIM.
We do a 3-year medium-term plan, so Abhishek, I think around 2% would be an FY23 number.
Understood. Thanks so much, Puneet. Thanks. And all the best.
Thank you.
Thank you. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, congratulations for a great set of numbers. So firstly, in terms of retail TD, if you can just highlight in terms of on a like-to-like basis, how would have been the overall growth? And the context is when we look at in terms of the hikes that we would have taken over past 3 to 6 odd months compared to the other players, we are relatively on the lower side. So should we see catch up on the rate side to further gather pace on the retail TD?
Yeah. Hi, Kunal. Thanks for that question. So as we mentioned, the entire focus is on getting the LCR accretive business moving. And based on the constitution-wise approach that we were doing, if I were to look at it on a like-to-like basis, I think the RTD figures would be somewhere around the 13% growth YOY. So that is where it would be.
Yeah, in terms of stance strategy on the retail TD rate.
Sorry, come again?
In terms of the retail TD rates, the way we have seen the increase is relatively lower compared to that of the other players. So do we plan to catch up and get the retail TD growth relatively at a faster pace?
So Kunal, this is something that we are watching very keenly in the market, and we would like to analyze and study as to where the market is moving. At this point in time, we feel that where we are for the particular tenors that we are offering our rates, I think we will continue to hold on to those and watch and wait and see how we play our game.
Sure. And secondly, in terms of wholesale or corporate advances, maybe at least on the advance side it is declining, but have we built up the position in the investment portfolio or the credit substitute, because there is significant rise in the investment book? So if we have to look at corporate plus credit substitute, how would have been the overall growth?
There was no, Kunal, this quarter there has been no material addition to the corporate substitute book. So what you're seeing on the decline that you're seeing on the corporate loan book is what it is. And as Amitabh spoke about in his opening comments, our focus segments are growing very, very strongly. And I think incrementally in other parts of the wholesale bank, as and when we see profitable growth, we will certainly chase after that. I think the quality of the franchise is unquestionable. We are gaining market share across various parts of the corporate bank. We are actually serving the customer across the capital structure, which means that there are loans that we do, there are bonds which we do, domestic bonds, offshore bonds. Much of that we originate and distribute and earn a fee. We are serving corporate India from Axis Capital. Almost 40% of all IPOs last year were led by Axis Capital. And so therefore, the use of the balance sheet is only one part of the relationship strategy that we have with the corporate bank.
Sure. And lastly on Citi acquisition integration, you highlighted steering committee and integration on, say, people, processes and technology. But otherwise, when we look at it, how has it been compared to what the expectations were? Any positive, negative surprise, and any maybe any read-through in terms of how credit cost or any incremental expense that would be incurred towards the integration when we are expecting it to complete by Q4?
Kunal, absent the CCI approval, we do not have full and complete access to Citi information for all the right reasons. This is what we are able to track publicly because some data points are published publicly. The Citi performance is trending in line with the assumptions we made at the time of the investment. That is all that I can say at the moment. Our best case estimate
liability side, retail TD, you indicated that large part of the reclassification is done. Now, just wanted to understand, over the next next couple of years, getting retail TD momentum back will be key to sustainable growth for the bank. So can you just highlight what steps are we taking? You can have a pricing play. You indicated about customer additions. Can you talk about the account deepening? What's happening to your corporate salary build-up?
Thanks, Adarsh. The overall piece in which we are looking at it is in terms of sweating the franchise to start with. And the way we are going about it is, if you would have seen our slide 17, you would see that we are moving in multiple vectors. One of them clearly states that how we are facilitating our staff, the frontline staff, in terms of enabling them to free them up from routine operation work. So if you see 65% of our branch service transactions have moved digital, and 94% of them are straight through, which gives us the lever to increase engagement with customers. So similarly, we have ensured that we are emphasizing our KRA changes for our staff, where the entire focus is on ensuring that there is, as Amitabh mentioned in his opening comments, the focus towards delivering an engine which is focused on growth. The productivity, whether you look at it in unit terms or value terms, is also moving quite strongly, and over the last couple of years it has moved by nearly 30% at a resource by resource level. Similarly, the product penetration that we are focusing on comes through the fact that, and that is why salary as a focus segment comes into play. And you would have seen that our engine on the efforts of salary, we have doubled the number of corporates that we have signed up, as well as rejigged our corporate program, the Ultima salary program. And at the same time, again, coming back to the ability to onboard the customer better, we have the digital elements of saying that whether it is non-salary, we have moved 26%, individual current sourcing, we have moved 55%, and similarly RTD, coming back to your earlier question, we are seeing 68-70% of the RTD onboarding going on to the digital. So a combination of freeing up service to sales capacity, ensuring that there are enablers which are in place, KRAs which are changed to reflect this aspiration of ours to create the growth engine, and then delivering the quality of growth that we are looking for, whether it be in terms of premierization, whether it be in terms of granular deposits, whether it be in terms of LCR accretive. So all of that are coming into play and helping us move in that direction. As Puneet mentioned, this is a long-term play that we are at, and the effort is to ensure that we are moving in this direction. The RTD book per se, I think the question on rates and how we are looking at it, as I mentioned earlier too, this is a market dynamic element. I do believe that we will wait and watch and see how competition, this is an interest rate upcycle, but we do not want to be the leader as of now. We will wait and watch and see how competition moves, but the idea is to be in front of customers and to see that we are able to get their better and better wallet share.
So just to add to Adarsh, everything that Ravi just mentioned in terms of what we are trying to do in the physical space, 68% of our RTD comes digitally. And so therefore, to that extent, we have improved the journeys digitally to ensure that that if you're seeing drop-offs, how can we ensure that drop-offs reduce, and so on and so forth. We really literally run hundreds of campaigns, to our base for retail term deposits, and each of these campaigns is run digitally based on data analytics that we have, and many of them are very, very successful. Some of them don't work, but I think it's and really what we're looking to do is increase these hundreds of journeys into hundreds of campaigns, into literally thousands of campaigns, and we are building out capabilities to be able to do that. We are also trying to optimize the funnel, meaning 68% of individual TDs come digitally, but we also need to ensure that as the customer is looking to redeem on maturity rate or looking for prepayment, is it possible for us to hold him back in some manner by making him an offer for a personal loan, for example, or a ODFD product are some of the journeys that have already got constructed. And so therefore, the digital team is looking at through data analytics, not just at increasing the top of the funnel, but ensuring that leakages don't happen as well.
Got it. No, this thanks. This is useful. My only observation, and just a follow up on this, is for some of the large brand banks, there is a certain retail TD accretion that normally happens, and you build on it either through rates or through efforts, and then there is an extra momentum that gets built in. What I'm just trying to understand is underlying there was a reclassification. So X that reclassification, how large that number was, how's the momentum? Because it looks like somewhere the underlying momentum has been quite weak, right? And then we have to do a lot more on, run on the treadmill to kind of get an organic accretion, which is there for some of the larger brands in terms of banks out there.
So I wouldn't disagree with you at all. I mean, this is a market where everybody has to be on the treadmill, given that it's an interest uptick cycle that is coming through. And as I mentioned earlier, that excluding the reclassification, etc., we would be somewhere ballpark around the 13-14% mark.
Okay, got it. Thanks, and all the best.
Thank you. The next question is from the line of Hardik Shah from Goldman Sachs. Please go ahead.
Yeah, thanks. This is Rahul here. Just taking the previous conversation forward on deposits and bringing in the element of branches. So on one hand, we see the CD ratios are elevated at 87-88%. Capital fair enough, 13-14%. But branch expansion is just 1 in this quarter, if I saw the numbers correctly. So how are you all thinking about it? And on one hand, we've got HDFC Bank, which is talking about massive expansion of branches. On the other hand, we are looking at higher LDRs, and then rates are rising. So what is the strategy around that particular element?
Thanks. So as I mentioned, the number of branches opening in Q1, you should take it with a pinch of salt, because you're kind of looking at places, identifying. But let me come back to what the bank is weighing in. As I mentioned, the focus is on sweating the franchise. At the same time, we are also cognizant of white spaces in different states across the country. So combination of both these will come to bear on the way we are looking, or the direction we take. The whole idea is to see that how I can get each of my existing branches own more and more of the catchment and take a better wallet share. And to that extent, we track it at a district by district level and see how we are moving across the 670 districts that we are present in across the country. So both in terms of the existing branches sweating, as well as any white spaces available across these districts, is where we are focusing on. And I think that will determine the way we look at it over the next 2 to 3 years of how our distribution footprint should be.
Okay,
I think just to put that in context as well, our mobile app today has 9.7 million customers who come to the mobile app on a monthly basis and transact somewhere in the vicinity between 10 to 12 times, which means that there are 100 million visits to the mobile app on a monthly basis. And so therefore, as we think about our physical strategy, I think the strength of our mobile app is something that we would superimpose upon that and think through in terms of the number of branches that we require over the next 2 to 3 years, as Ravi mentioned, to be able to fill white spaces, some of it physically and some of it digitally as well.
Okay, thanks. Just another question is on the growth sequentially. So, of course, the headline numbers are sort of indicating a sort of marginal decline led by corporate. But when I look at the retail book also, the secured portfolios have seen a slower quarter-on-quarter accretion. Maybe some seasonal factor, could have been there. But just trying to understand, did we see any pricing pressure there too, or how's the repayment rates, trended in those portfolios, or it's a calibrate or sort of conscious decision to sort of calibrate more towards unsecured and go a little slow on secure? How do you think about the mix changing going forward and what has happened in this quarter?
So overall, as we've guided that we would be directionally moving towards a bit more of unsecured than what we've done. So our disbursement this quarter was about 22 unsecured versus say 19 of last year. So that journey continues. This quarter has been all about rate transmission, increasing fee, and also therefore keeping at the same time ensuring that the volumes do come in. It's been a bit of a timing difference in terms of rate hike. We've been acutely aware that we would like to transfer the rate increase to the customer. That's why you see numbers which are there. But overall, a year-on-year growth of about 25% is a pretty healthy growth, and this momentum is going to continue in the remaining of the year.
And there, would you say that the repayment rates or the prepayment balance transfer, etc., would have been normal that you've witnessed otherwise?
Yeah, it's been a normal year in terms of repayment, so there's nothing extraordinary.
And just wanted to squeeze in one last question in terms of credit cards. Very strong momentum there. So can you just throw some light around what would be your revolver rate? What would be the EMI portion out of the spends that you all have?
Yeah, hi, Sanjeev here. See, revolver rates have reduced for us and for the entire industry, right? So that has gone down, which essentially means that a lot of revolvers went out with the credit cycle, which we saw a couple of years back. Apart from that, we are seeing behavior where customers were revolving a couple of years back and are now displaying more of transactor behavior. We believe this always happens after a credit cycle. Last time it happened in India in 2007-8, it took almost 4 years for the industry to recover to the normal revolver rates. Our sense is this time it's going to be faster because the growth rate is much faster, right? Having said that, our strategy is pretty clear. The book is clean. We see opportunity in the market organically. We see opportunity in the form of partnerships. We will grow our franchise. The rates will organically recover over time. We are not unduly worried by the fact that revolver rates are low right now. The balance sheet and the business can earn monies which are reasonable even in the context of lower revolves. So we'll stay with the strategy we are playing out right now.
Your revolve would be below industry levels or would be at par with industry?
There is no published metric on this, so very difficult to say what the industry is at. We believe everybody is lower than where they were by a certain level. There is no published metric on this, so very difficult to comment.
All right. Thank you.
Thank you. The next question is from the line of Mahesh MB from Kotak Securities. Please go ahead.
Good evening, sir. Just a couple of questions. First is on slide number 10. With respect to the spread improvement that you reported this quarter, how much do you think would you attribute to the loan mix that is sitting out there? Either loan mix or the balance sheet changes.
So Mahesh, thank you for the question. We haven't split the 13 basis points, but the 13 basis points will be a mix of repricing effect on our floating rate book plus the mix effect. But we haven't called out which driver has constituted what amount.
No, the question is more in the sense that would you say that, is it fair to say that the decline in wholesale book would have contributed to the margin expansion, or you think that's an incorrect assessment there?
So the decline in wholesale book would have contributed to the bank margin expansion because we ran down the trade book. So that is a correct assertion. However, to take that assertion to the conclusion that that is the only driver of margin expansion in the current quarter would not be correct.
Okay.
There are drivers like our CBG book and retail book delivering superior growth and superior pricing. The fact that we have had a reprice that has taken place in the last quarter that is to fully play out. The mix shift between INR loans and FCY loans. So the four drivers that I keep talking about, the reduction in the RIDF book, all have contributed in parts to make sure that the spread has expanded by 13 bits. So I would not like you to leave with the conclusion that, or if I were to frame or paraphrase your question, I don't think I will lose this spread once I start growing my wholesale book. Okay. So that's the other way to answer your question.
Perfect. That's useful. Second, if I were just to look at the same slide and just kind of look at how do you see the pricing of the loan book changing over the next couple of quarters given the yield movement for your portfolio?
So Mahesh, about 70% of my entire loan book, to be precise, 69 odd change, is floating rate linked, of which roughly about 30% is repo. We've had one cycle of repo rate hikes happening in the current quarter. Assuming that another rate cycle happens, we should see that repricing take place. MCLR, if you look at how we've actually put out data for you to make an independent assessment, we have a pretty broad spectrum reprice on the MCLR. Of the 23%, about half of it reprices over a 12-month period. So the MCLR reprice is going to be more out in time. The repo reprices will be faster. There is going to be a component of the 30% fixed rate book that pays itself through the next 12 months, which will also reprice. So that's how I am looking at the reprice effect on the book over the next 12 months.
Okay. Sure, I'll just take this offline. But just if I were to ask one last question, slide number 14. You've seen an improvement in the LCR on a QoQ basis. You say that the exit LCR is 123. There has been no material change in the balance sheet on the asset side. If anything, there's been a reduction in cash balances. Just trying to understand what would explain an improvement here.
Mahesh, I've articulated previously that we had two levers to improve our NIM, the composition of our liabilities and the quality of our liabilities. The relative quality of our liabilities has improved on a quarter-by-quarter basis. So if you look at the LCR disclosure, the outflow rates would have come down, which therefore results in an improvement in LCR. The 123 is the exit number.
Sure. Useful.
It is the journey that we set out that we will get to.
Perfect. This is useful. Thanks.
Thank you. Ladies and gentlemen, we'll take the last question from the line of Saurabh Kumar from JP Morgan. Please go ahead.
So just two questions. One is, the mark-to-market. So I'm assuming this is mostly coming from the corporate bond book. So could you just highlight what is the duration here? So that's the first one. And second is on your fee to assets. So how should we think about it? Because if I look at from pre-pandemic level, it's growing about 10.5%. So as the unsecured mix rises, should one reasonably assume fee to assets to improve? These are two questions. Thank you, sir.
Thank you for the question. We've called out the color of the rating profile of our corporate bond book. So we said that 98% of the book is A- and above, and 79% of the book is AA and above. We haven't called out the duration of the book, but it is not a short duration book per se. Okay. So if your question is the pull to par duration, the pull to par duration is a multi-year duration versus a 1 year duration or a shorter period that one may assume.
Okay. So in this quarter, you were not exposed to the short end of the curve. That was the question.
That is correct. So all of it is, in fact, if I were to make a assessment, nearly all of this is corporate bond book, and when I mean nearly, I mean it's tending towards 100% is the corporate bond book. We've explained to you there's no economic loss, and it'll be a multi-year pull to par.
Okay. Okay, got it. So second on fee to asset.
Look, I think we don't offer guidance on fee to assets, so I think historical performance would be the best reference that I will let you draw to. We really don't have a specific guidance on fee to assets currently.
Okay. All right, sir. Thank you.
Thank you. I now hand the conference over to Mr. Puneet Sharma for closing comments.
Thank you, Nirav. Thank you, everyone, for taking the time to speak with us today. If we've left any questions unanswered, we'd be very happy to speak with you offline in the course of the evening today. So please do reach out to Abhijit for any further questions or clarifications. Thank you very much for spending your evening with us.
Thank you very much. On behalf of Axis Bank Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.